Hello everyone, Billy and Shaun here. We're here with you today to talk about two things as we approach year end. I want to talk a little bit about the volatility. Of course, that's still a prevalent factor in the markets. And secondly, we'll talk about some year end planning ideas. So let's jump right into what we're seeing right now in the markets. Volatility, as we're talking about on this chart, we want to stress how important it is to remember the long term when you're an investor. Some people start trading and becoming more of a short term thinker, but this is what really applies here is as markets get volatile, we start seeing it's more normal than we actually expect. If we see this chart, this is year 2017, where we see that the periods of plus or minus 1% changes in the market for the S&P 500 was very low. Matter of fact, there was only 8 days when the market was up or down at a 1% level. Now in 2018, we see that number has gotten a lot bigger, and we're up here closer to the 60 or 70 days where we've had 1% swings. But if you look at the long-term average, it's actually very common to see 80 or more days where you have increases or decreases larger than 1%. Sometimes even 4 and 5%, as you see up here in the top brackets. So I just wanted to stress how important it is to stay long term. Don't panic when things are going like they are, because when we get volatility, people can get emotional and want to react and think that there's something wrong or there's something that needs to be done. And Shaun and I like to stress that it's the time in the market, not timing of the market, that's the important part. These markets always have a tendency to overreact one way or the other, and we want to stay thinking long term, stay diversified, and stay true to our philosophy. We're going to go back to just kind of talking a little bit about some year-end ideas here now.
Yeah, some of the things that we implement towards year-end, well, there's a few different ones, but one that we use often is tax loss harvesting. We use this for clients to help manage their tax bill at the end of the year. So say maybe throughout the year a client had a holding in Apple and they had a large gain and they elected to sell some of the shares. Well, that triggered a capital gain. There's a strategy to offset that by looking at their account. Maybe they have an investment, a holding, say like a GE or something that is showing a loss. So we can go in and sell that to offset either part or actually the whole gain of the Apple transaction. And then we can invest that in a similar company or something else, or actually wait 31 days and buy GE back. And that's called a wash sell rule. So that's one strategy that we use very often.
Another item that comes up at the end of the year is called capital gain distributions, and many mutual funds that are owned throughout the year actually start declaring the capital gains that they will pay out to their shareholders. So for example, if you owned a mutual fund for a long period of time and that mutual fund was investing and making all the investment decisions, and they owned a basket of securities, and they owned Google and Apple and Netflix and so on and so forth, and many of those had big runs, and that mutual fund decided it was going to sell some shares throughout the year, and then at the end of the year they need to pay tax on those gains. So they're going to issue what's called a capital gain distribution, and that's going to be a prorated distribution depending on each shareholder's percentage ownership in the fund. So if you've been a long-term position holder with the mutual fund, it's not so bad because you've got a gain and you're sharing in the taxes associated with those securities. However, if you're shorter term and you came a little late, you entered that fund maybe during the year, and you don't have the exposure to those gains. Matter of fact, you might even be showing a loss since the date that you bought the fund. It might have even gone down in value. That doesn't change the fact that the fund already sold those securities and booked a gain on those. Now that you're a shareholder, you're going to be treated just like all shareholders, and you're going to share in the prorated distribution. So it sometimes becomes very hard to digest that as a shareholder who was more recently invested. That is one of the areas Shaun and I focus on, is to go through and determine if it makes sense for a client to sell that fund before the distribution and avoid having exposure to that tax obligation. So you'll see that sometimes in your statement or online, that you might see us selling a fund for you. There's a reason behind us doing all of those things.
Sure. One other strategy we have clients look at and determine if they want to do is called gifting. Some will do this to reduce the size of their taxable estate. Some like to do it just so their kids or grandkids can enjoy the benefit of their hard-earned money. So there's gifting laws that we have to keep in mind, and this year the IRS has said you can give $15,000 to any individual. So another thing that is to be considered for year end.
And then another thing, some people are charitably inclined and they like to gift money to organizations or charities of their choice. So one thing we talk about a lot is the different ways to do that. Certainly you can write a check out to your church or to a school or to a museum or a hospital. Sometimes there's better ways to do it where you can maximize the tax savings. And we talk a little bit about donor-advised funds. So that's something you might want to write down and talk to either us or your tax advisor or CPA about to see if it makes sense for you. It makes a lot of sense for those individuals who might have exposure to a big tax bill in the given year, where they sold a business, they sold an asset for a fair amount of money, and they're looking for some tax deductions, but they're also charitably inclined. The donor-advised fund allows you to get a larger deduction up front. You're not necessarily giving the money to any charity yet. It's going into an account where you still have some control over how it's invested and then future distributions. It's really nice because clients can give that money over the period of even their lifetime and even beyond, name their children as the future advisors. So we have clients that set these things up and they last for generations and they get the tax deduction all up front. It's really nice to also spread out the donations rather than being forced to give to one organization that might end up being something that you didn't really intend to do, sometimes mismanagement in these charities. So again, donor advised fund is a really, really nice idea for tax savings and management of those charitable contributions.
Sure. Another big one, retirement plan contributions. So we'll pull up the limits here.
Or the limits, let me go there.
So for 2019, 401ks, 403bs, 457s, those are the big ones. So 2018, 18,500 is the max. We're going to get a little bump going into 2019. There's also a catch-up provision you can see for $6,000 on each of those retirement plans, and then you have your Roth IRA contribution limits. Currently for 2018, they're $5,500. 2019 $6,000 and $1,000 contribution or catch-up contribution limit to those. So those are the most well-known ones. There's a few in between there that are more specific situations, but those are the big ones to keep an eye on.
So that being said, everyone, we just wanted to tell you thanks, and we will be here if you have any questions or need anything before the end of the year.
If we don't talk to you, have a very Merry Christmas with your families.
Take care out there.